For more on what caused the plunge, we are joined by John Coffey. John is former member of the SEC Advisory Committee on Capital Formation and is a securities law professor at Columbia University. He joins us now from New York to discuss what is likely to be accomplished at today's meeting. Welcome to you, Mr. Coffey. Great to have you on the show. We also learned today that Congressman Kanjorski is called to hearing tomorrow. So with all of these hearings and discussions, what can we realistically expect to learn about how and why the markets took a dive and then climbed right back up last Thursday?
Well, there is still a good deal to be learned, but it does appear that this is a replay of the 1987 crash, which was also computer-generated. The one big difference is that in 1987, the New York Stock Exchange was the one venue for New York Stock Exchange-listed stocks. Now there are basically four major markets: the New York Stock Exchange, NASDAQ, BATS, Direct Edge, and a dozen or more smaller players, too. And the absence of common criteria across all of those market centers may exacerbate the problem. Thus, when the New York Stock Exchange slowed down trading on Thursday afternoon, that was clearly well-intentioned. It was intended to get human beings back involved in the process, but it may have kept some buyers from getting to some sellers and halting the price decline. So I think the number one priority will be trying to get some common criteria and possibly some common revised circuit breaker rules adopted by all of these market centers.
So, using your historical reference, John, what happened after in terms of regulatory action after the '87 crash that stabilized markets really for another generation until just last week?
Well, '87 to now, we can call it a generation. Seems like yesterday to me. There were agreements. Circuit breaker rules were put in place, and circuit breaker rules did calm the market.
Why didn't the circuit breakers work last week?
They didn't reach the bottom 10% level, and 10% may be too low a circuit breaker. I could easily see agreement being reached on maybe a very short trading halt for 10 minutes, 15 minutes, if there were a 5% market decline. That would give us a chance across all markets for potential buyers to recognize there was no new information and that they were willing now to buy.
Okay, Professor Coffey, you say that maybe trading didn't reach a certain level, but in an 8-minute span, $700 billion was erased.
That's an argument for why we should have a shorter circuit breaker, a shorter fuse. A 10% decline in a market that was at 11,000 means that you have to have 1,100-point decline. We didn't quite get there. It may well be that we want the market circuit breaker to kick in at a 5% decline or some other number that the consensus of market centers feels is appropriate.
So how do you regulate this black box high-frequency trading in a way that won't send business overseas?
Well, the problem with this is we really can't tell any institutional investor that they can't sell. That would really freeze and paralyze markets. But right now, if all institutional investors have pre-programmed computerized strategies to sell on a predetermined market decline, let's suppose it's 2% in one stock or 2% in the market as a whole, then all players in the market are at the mercy of the institution that has the shortest hair trigger.
Right.
Because that hair trigger will set off the next several triggers below it until we get down to the 5, 6, or 7% decline.
Professor Coffey, you have about 30 seconds left. Would it be useful then to have all those markets that you mentioned work together in an effort to apply the brakes when things seem to be getting out of control?
I think you don't have time for judgment after the fact. I think you have to agree in advance on what would be the point at which a short-term circuit breaker we put in, and also an agreement that whether or not one exchange can stop trading. The New York Stock Exchange slowdown, that may have exacerbated the problem.